Okay, today's Cardinal Lesson, one big, beautiful bill of 2025, signed on July 4th, signed into law July 4th. Some of the provisions go in effect immediately. The acronym for this is kind of like OBBBA, uh, or OBBA, or whatever you want to call it, OBBBA. And so, why are we talking about this today? Well, we've pulled out 11 specific provisions, or the major provisions, the effect on taxes, um, and the effect on the filing of your taxes, the paying of your taxes. And we're going to go through that point by point by point today. I want to push it to Tom, and I want Tom to share, like, why are we doing this video? Why is the subject today OBA?
Yeah, I mean, we're doing this video because, like Hans mentioned, this law was signed into law in July 4th of this year, 2025, and it affects everybody. If you are watching this video, there are provisions in this law that will directly impact you. And you need to know what those are and how they work and what planning opportunities or things you need to be mindful of. And so we just want to walk through the major provisions. There's some things in law we're not going to touch on today, but again, the main ones that will have a planning implication is really what we're going to focus on today. So let me bring up the show notes. These are below the video on our YouTube channel. They're also on our website at cardinalguide.com. And again, as always, we have the board. A lot of people print it out, take notes on it if that's something that you're interested in. This yellow chart really gives more detail. A lot of this stuff is what's on the board, but it goes into a little more detail than what we could fit on the board. So print that out. I think it's really helpful. And this orange chart you've seen a lot in our videos. It really has a lot of good sort of a one sheet with a bunch of different tax rates. Here are the ordinary income tax brackets. We have capital gain brackets, some standard deductions down here. So there's a lot of good information on here. It's been updated to include the provisions in the law, specifically the $6,000 senior deduction. We have the SALT deduction for itemized deductions, the increased standard deduction. So all the information is updated. So if you've seen this before, go print this new one out, because again, it has all the new numbers and things to be mindful of. So what we're going to do is I'm going to turn it back to Hans. We're going to go through sort of provision by provision, talk about why it's important, how it impacts you, what planning opportunities or things to be mindful of, and so we'll just get started here.
Okay, so the first and most important provision is the reduced federal income tax rates are extended permanently. So as you'll recall, the tax law passed in 2017, Tax Cuts and Jobs Act, lowered tax rates starting in 2018, and there was a sunset provision at the end of 2025 or the beginning of 2026 where the sun set, and the tax rates were going to revert back to what they were in 2017 before they reduced them. So it had a time frame on it. And so all of our planning that we've been doing was assuming until this thing really gained steam in May and June, and it was pretty close to passing. Prior to that, we were just thinking that these tax rates are going to go up in 2026, and we were doing a lot of planning accordingly. And then, surprise, surprise, this thing got passed, and the lowered tax rates were extended permanently. So, and just for an example of how that applies, like when we're doing Roth conversions and we're planning for Roth conversions, the top of the 24% bracket for a married couple was about 380 some thousand dollars. And that's a lot of income in one year. And so when you had somebody that was around 100, 150,000 that they're living off of and paying taxes on, it gave us room to do a couple of 100,000, maybe a little bit more of Roth conversion, and still not pay any more than 24% federal tax. And so that was something we wanted to capitalize on before the 24% bracket went to 28 starting in 2026. Well, this first provision just extended these rates and the inflation setting of the brackets uh, indefinitely. Okay, now uh, don't think that it's permanent, because the law says they're permanent, but they're going to change this stuff again sometime in the future. But at least for a reasonable period of time, we know what we're dealing with. Tom?
Yeah. I mean, I think this one, when I say it impacts everybody, everybody who pays income taxes is affected by this. Now, one of the things that I just want to, remind you is what happened in the law is they prevented the taxes from increasing. So they're not decreasing from what they are, what they were previously. It's just staying the same rate. And so if you're thinking my taxes are going to go down, the rates really are, I mean, they're going to stay where they were, and so preventing an increase is still very helpful. Like I think this is a good provision for when you're doing planning. But it's not that they're going to decrease. Now there's other provisions we'll get to that might decrease your taxes some, but it's not because of the changing rates. So again, I think this one is the biggest provision that was really the main focus of a lot of the bill. And then we'll get into some of the other ones. The next one on the list is the estate tax and gift tax exemption. And so similar to the tax rates in the old law, this was set to sunset in 2026. It was essentially going to get cut in half, roughly, and so that's a big drop if you are in, if you have quite a lot of money, maybe you have a small business or a farm or something like that. This was going to impact quite a bit of people. But what they did in this new law, this OBBA law, is they've starting in 2026, they've increased the exemption to $15 million per person. So if you're a couple, that's $30 million. If your estate is below that number, then you don't have to worry about this federal estate tax. Now, there's some states that have their own inheritance tax or estate tax, and so we're not going to get into that today because every state's different. But from a federal estate tax standpoint, if you're below 15 million or 30 million as a couple, you don't have to worry about this. So I think this will remove. It's going to exclude a lot of people that were going to be impacted by the cuts, and they've just extended that out indefinitely. Like Hans mentioned, with any tax laws, indefinite is sort of a, we don't know where the end to that is. There's no planned change, but a new administration could come in, a new Congress could be elected. They could change these rules. Again, we have no way of knowing when that will happen. But tax law changes pretty frequently. So I don't think this will be the law forever, but for the foreseeable future, this is what we're dealing with, and I think it's a good change to allow people to pass on money to the next generation without having to worry as much about these estate taxes.
Okay, so now the 20% qualified business income deduction was made permanent, expanded income limits. So, how does this affect people? Well, if you own a small business, or if you're self-employed, or you're an S corporation, is all your earnings in your business flow through to your personal tax return. And under the Tax Cuts and Jobs Act from 2018 to 2025, they put in this thing called the qualified business income deduction. And it was giving self-employed people the benefit is that corporate income taxes were reduced under the Tax Cuts and Jobs Act. And then the extension of those, the corporate income tax rate was down as low as 20%. And so what they're doing is they're giving small business owners the benefit of that deduction. And they made this thing permanent, and they also expanded some of the income limits. Tom?
Yeah, I mean, I think the whole reason for this provision, the QBI, like Hans mentioned, was to essentially not penalize self-employed people, right? It's to give them a similar rate as the corporate tax rate. When we start thinking about planning, if you're watching this video and you're thinking about retiring, maybe you are self-employed, maybe you have your own business. If you start doing things like Roth conversions, because this QBI has income thresholds, right? If you make above certain amounts, you start losing this deduction. And so this is an area where you got to be careful, right? If you start doing a lot of Roth conversions, it could push you above the income thresholds for the QBI, and then you lose that deduction. So again, from a planning standpoint, that this could have some impact on you. Uh, I don't want to get too far into the details on that in this video because we got a lot to go over. But if you're in that situation, if you are self-employed, you've been taking this deduction, and you're thinking of Roth conversions, call us or call somebody who knows this stuff, because again, there could be some serious impacts there. The next provision, and again, this one is going to affect a lot of people too, is they've increased the standard deductions. So one of the things that happened in the Tax Cut and Jobs Act that Trump signed in 2007 was they really increased the standard deduction, which really meant a lot of people who were itemizing were no longer itemizing their deductions. They were just taking the standard deduction. It simplified tax returns and made it easier to do the calculations. And so they've increased them to 15,750 for a single tax filer and 31,500 for a married. If you're 65 or older or blind, you actually get an additional 2,000. If you're filing a single tax rate, you get an additional $2,000 uh, added to that 15,000 number. And if you're married, you get an additional 1,600 per person who's 65 or older. So there's some calculations there, but they've increased that standard deduction. That again, what most people are taking. Some of the things we'll get to a little bit later might lead to more people itemizing, especially if you're in those high income tax states. We'll get to that in a couple provisions from here. But the increased standard deduction means you just pay less in taxes, right? Everything, all else being equal, income the same, everything else being the same. If you have a higher standard deduction, you get to pay less in taxes. So I think that will be beneficial.
Okay, you had a little slip there when Trump signed the Tax Cuts and Jobs Act in 2017.
27, yeah,
And
not
I think I heard,
2007. Yeah,
I think I
2017.
heard
Yeah,
2007 was when you were a teenager, Tom.
that's true. That's
I'm
true.
just kidding. Had to get a little dig in there. I wish I was a teenager in 2007. Any case, the effect of the standard deduction, it's here to stay, and that's pretty significant. I mean, we find a lot of our high income people are, especially seniors, are just taking the standard deduction, and it makes your tax return simpler. And a lot of them don't have mortgage interest, and you get extra money when you're 65. We're going to talk about more extra money. Um, so this is just extended and increased. So then there's this $6,000 senior deduction. And what's important about this is only in effect from 2025 to 2028. So you need to know that. It went in effect immediately. So when you do your tax return, if you're 65 or over for 2025, which is passed in the middle of the year, you're going to get this thing if you qualify, and your spouse is going to get it if he or she qualifies. Um, it's available to those who itemize, and um, it's available to those who itemize and don't itemize. I mean, so in other words, this will be stacked on top of the standard deduction if you qualify. So, and it's $6,000, $12,000 for a couple of deduction, and it phases out if you're a single at $75,000 of adjusted gross income or more. It starts the phase out at 75, and it has an end point. It starts it at 150,000 if you're married filing jointly. So the effect of this thing is going to have an effect on Roth conversions. And again, we can't let stuff be a stop sign to the Roth conversion. Is people say, "Oh, I'm not going to convert anymore. I'm going to only convert up to 150 grand of income." Well, maybe, maybe not. I mean, when we're advising people, this is one more thing that we got to look at. By doing a big Roth conversion, we're going to be giving this thing up. We've already been through it with a few clients who are doing planning. And once we explain it and we put the numbers up there, some of them are still wanting to do the Roth conversion and just give this up. Tom?
Yeah, I mean, I think this is another area. It just adds another piece that we have to consider when doing the Roth conversions to put some context on this, right? If you're in those income limits or you're approaching those income limits and you start thinking about doing Roth conversions, your marginal rate would be in the 22% tax rate, right? That would be the highest marginal rate. And so if you lost that full $6,000 deduction, I mean, we're talking about, taxes at the 22% rate, like 1,320, 20 is the amount of tax savings that you have from this deduction. So some people will get focused on this. They don't want to lose that. The benefit of the Roth conversions over time could far outweigh that tax savings in that individual year. So to Hans's point, that doesn't need to be a complete stop sign to not do it. It's just another factor that we have to consider, right? That's something that we want to keep an eye on. But again, this is an additional benefit. Now, one of the things that I've seen sort of confused about this is no provision in this law directly talks about reducing taxes on Social Security, right? The formula that how they calculate Social Security taxation has not changed. It's the same thing. What the provision that might have some seniors paying less taxes overall is this additional $6,000 deduction, but it is not directly tied to Social Security. So I think that's something that is a little bit confused. So, but this would be if there's anything in the law that helps seniors who are on Social Security, it would be this specifically. But again, it has income limits, right? If you make above certain amounts, you lose this deduction. So again, not saying you shouldn't do Roth conversions or things like that, just be aware that it could have some impact on this additional $6,000 deduction here. This next one, and again, this will be important for people in sort of high income states that have a high state income tax or high property tax. Think of New York, California, New Jersey, places like that. And there's other ones around the country. It in the previous law, the Tax Cut and Jobs Act, there was a cap to the amount of state and local income tax or property tax that you could deduct on your federal tax return. The cap was $10,000, and that was it, right? Even if you paid $50,000 in state income tax, didn't matter. You were capped at $10,000. This was one of the provisions that had a lot of debate back and forth between Congress and the Senate. Where it finally ended up is they've increased that cap from $10,000 to $40,000. So again, this is a pretty big increase, right? So now if you have state income taxes or property taxes up to that 40,000, you get to deduct a lot of it, and that could bring in more people itemizing in those high income states with high income tax. And so I think that that's a good thing. But again, there's income phase out limits, and so specifically, and it's much higher than the the 6,000 senior deduction. One thing of note is it's the same income phase out for a single tax filer and a married filing jointly tax filer. So there is no difference, and it's $500,000 is where that income phase out starts. And so if you earn above $500,000, then you start losing that 40,000 that you're able to deduct. It will never go below the 10, so you'll always be able to claim at least 10,000 on your tax return as an itemized deduction. But if you can stay below that 500,000 number, then you can deduct up to 40,000 of those state and local income tax. And so again, I think it's a good provision. It could be a reason to maybe not push your income above from Roth conversions, specifically above 500 if you're in some of these states that have these high state taxes. And again, with all thing, it needs to be part of a larger plan. You need to consider all these different pieces and not focus on any individual one because it has impacts across the board. But again, I think it's going to bring in more people potentially itemizing, and the more you can take as a deduction, the lower taxes you have to pay, which would again ultimately it would be a benefit for you.
Okay, yeah. I mean, you add in the state income taxes, and then real estate taxes. Um, you put those two things together, but I want you to know that the cap of 40,000 is not that far above the married filing joint of standard deduction. So that's what's really it. Do you take itemized deduction or do you take the standard deduction? So this might end up not being as big of a deal as people really think it is. So um,
And I agree with that, right? I think the area that you might see people doing it is if they have other itemized deductions, like maybe they're giving to charities that they can stack on top of what they're paying in state income tax, or if they have home mortgage interest, right? Some of those things that they start adding up can be beneficial, but if your only itemized deduction is this, I mean, it's a little bit better, but not that much better than what you were getting as a standard deduction.
sure. Okay, reduction of itemized 2026 deduction for those in the 37% bracket. So, and I think it's reduction for those in the 37% bracket, but they're just that top bracket, even though they extended it permanently at 37%, they got a little hit that's coming in here. Tom?
Yeah, I mean, I think they just, they had to pay for some of these provisions in the law, right? And this is an area where, like, okay, if you're a high income earner, you're at the 37%, and you're itemizing, we're just not going to let you take the full itemized deduction. Which, at the end of the day, I don't know that people are watching that closely that they'll even really realize this is going on. But it is a way, because again, some of the stuff in here costs the government a lot of money to do. they got to pay for it somehow or try to pay for it, and that's one of the provisions there. This next one, and again, this one's a little bit sort of nuanced, but they're changing, and this one doesn't start till 2026. So for 2025, you don't need to worry about it. But for starting in 2026, they've added some different provisions for charitable deductions. And so it used to be if you were taking the standard deduction, which most people were, then you didn't really get any benefit from giving to the charity, which most people weren't giving to charity for the tax benefit. But it's not a bad thing to get it if you're already giving to charity. But again, it only mattered if you were itemizing. If you're taking the standard deduction, it doesn't come into play. Starting in 2026, that will change. And so for a single tax filer, even if you're taking the standard deduction, you're still able to deduct $1,000 as a charitable gift. That would be added then to the standard deduction you're taking. If you're already itemizing, you're going to get the full. I say full. There's some other provisions, but it's just for today, I'll just say you'll get the full deduction if you're itemizing. But if you're taking the standard deduction, now you do get benefit from giving some up to $1,000 for a single tax filer, $2,000 for a couple who are married filing jointly. And so again, I think this will be benefit you there. I don't know, John or Hans, if we want to get too much into sort of the other changes of the charitable deductions starting in 2026, or do we want to leave that?
Not really. No, I think today, I mean, we'll do another video on that. This is a big part of the planning that we do. And people are just going to be as confused about this as they were. They didn't need to turn in their receipts. I have some clients that I, help them prepare their taxes to send them to the CPA to do. And they keep sending me receipts since 2018 for charitable donations when they're small and they're taking the standard deduction anyhow. Now they're going to be able to deduct either up to 1,000 or 2,000, single or married. And so now it's back on. Now you need to keep the receipts to the extent that they're that if you're taking the standard deduction.
Let me give you one sort of practical tip if you're, and again, this is a very specific person that I'd be talking to here, but let's say you're above 70 and a half, and you've been doing QCDs, and we have other videos on this, but qualified charitable deductions where you give money directly out of the IRA to the charity and you never have to pay taxes on that, which is great. We love QCDs. We use them all the time. You might want to consider your first, I'll just say you're a single tax filer, your first $1,000 you might want to give with just cash and not out of the IRA via QCD, so you can claim this $1,000 deduction and then do the QCDs above that, right? That would be an example where you can sort of play these against each other and get benefits from both. And so, again, this isn't starting until 2026. There's time to sort of plan around this, get some, figure out what you want to do. But there's things that you need to just be mindful of when it comes to planning.
Okay, tax deduction for tips. I mean, it's just there aren't a lot of our clients that are receiving tips because they don't have a job as like working in a restaurant or doing something where they're tips. But to the extent that they do, we also have a lot of clients who work part time, and if you're receiving tips, so they're going to get there's going to be a tax deduction for tips, and it's going to be in effect from 2025 to 2028. So this thing has a sunset on it, but this went with one of the campaign promises of Trump, and you're seeing it right here is that people are not going to have to pay taxes on their tips essentially up to a certain amount. And there's a maximum deduction of 25 grand, same single or married. It phase out at 15, it's 150,000 for single and 300,000 for married.
Yeah, I
John?
mean, I think if you're in a scenario where, like Hans mentioned, you maybe have a part-time job, you're getting tips, like a server at a restaurant or something like that, Roth conversions, you could crowd you out of this, right? Because anything that has an income threshold limit to it, which a lot of the provisions in here do, if you raise your income by things like Roth conversions, you might lose some of these other ones. And so everyone's situation is different. Every calculation is different. None of this is sort of just a broad brush recommendation for anybody. It needs to be specific to you, but it's something to consider. The next provision is similar to the taxation on tips, and this is the tax deduction for overtime. And so again, this was another campaign promise. Similarly, the numbers are a little bit different. So for a single tax filer, the deduction is up to 12,500. For a married couple, it's 25,000. Again, there's also income phase out limits. Same 150,000 for a single, 300,000 for a married couple. But if you're getting overtime, you're getting paid on overtime. You'll be able to take a deduction off of your taxes, again, which reduces the taxable income. Now it's not reducing your adjusted gross income, which has effects on things like IRMA and other stuff in the tax code, but your taxable income will be reduced by the amount of the overtime pay up to those limits. And so it's still I guess we'll have to wait and see how all this gets reported, right? Because in the past, employers didn't have to keep track of which money was for overtime, which one was not. This provision starts in 2025, so I'm guessing there'll be some uh, confusion probably of how everything gets reported on like your W-2 when you get it. So talk to your accountant or CPA or tax preparer. That they'll by the time you're filing taxes, we'll have some guidance of how to handle that. But at the end of the day, if you're in getting tips or overtime, this will reduce your taxable income at the end of the day, which means you pay less in taxes than you would otherwise.
Okay, the child tax credit, not going to be for most of our clients that are pre-retirees, but certainly their grandchildren and their children. It permanently increases to $2,200 per child. And keep in mind, this is a tax credit, not a tax deduction. So it's like money in the bank with inflation increases in the future. And this has an income limit of 200,000 for an individual and 400,000 for married filing jointly. So if you're over those amounts, you don't get it. If you're under those amounts, you get it, and it's like cash. Tom?
Yeah, I mean, I think this is going to be very helpful. Like I said, most of our viewers are probably not taking advantage of this, but your kids probably will. Like if you have grandkids, this will help your kids there. So I think it's a good provision. And then the final one we have listed up here, and again, there's more in the law that we haven't touched on today. There's stuff that address health insurance and things like that that we didn't get into. But the last one we have on the board here are these Trump accounts. Now, these ones, they're a new type of account that are created. They can't be opened until July 4th of 2026. I think they did that to give themselves some time to figure out how the logistics are actually going to work. There's still some things that we need clarity on, and we'll do a future video on this once we have more information on it. But fundamentally, what it allows you to do is to add money into an account for the benefit of your child. They need to be under 18, and it's a way just to help sort of gift some money to them, if you will, that they can't touch. They don't have access to it until 18. One of the sort of unique things is if your child was born between 2025 and 2028, so it's that window of time, and you open one of these accounts, the government will seed it with $1,000. They will give you $1,000 directly into that account. Again, we're not quite clear how all that's going to play out because they need to release some guidance on that. I will personally benefit from this. My wife, Chelsea, she's pregnant with our third child who's due in November of 2025. So when these accounts become available, I'll be opening one up for him and probably one for my other two kids as well. But the one who's born in that time frame will get this extra $1,000, which if they're going to give me extra money, I'm certainly going to take it. It's going to be treated similar to an IRA, right, where you can put money in there. It can grow tax deferred. Again, we're not clear yet if they'll be able to do Roth conversions in the future. More clarity needs to be given on that. But I think from a planning perspective, a lot of you watching this video might have grandkids that you're interested in potentially putting money in there. One of the things that you'll have to consider is it better to put in one of these Trump accounts or a 529 account. The 529 account, right, needs to be used for education. The Trump account does not. But I mean, there's just different nuances there. So if you're questioning that, give us a call. We can help walk through what makes the most sense for you.
Okay. This bill is a big deal, at least in our world. And we've spent a lot of time studying it. We've already, it's been the law for a couple of months. A lot of provisions go into effect immediately. And certainly the provisions that start next year, we've already used this in planning in our software that we use to create the financial plans. It's already updated. So this is a big deal. And I'm just going to go over how this affects the comprehensive financial planning that Tom and I do. Um, it started, the whole video has been about taxes. It's been about estate planning, especially where you get into the increase in the uh, the exemption for estate taxes. We've covered income. We talked a lot about Roth conversions and its effect that we're going to have on there. And we haven't talked much about Social Security and Social Security taxes, but we mentioned it. So I want to bring Tom back on. I'm Hans Scheil,
And I'm Tom Griffith.
and we thank you very much for listening.
Thank you.